Hello. We're going to do a series of 5-minute introductory videos on various topics within banking and finance. So there'll be the introduction and then there'll be subsequent videos that delve into that topic in a bit more detail. Today we're going to do economic value of equity. What is it? So economic value of equity, EVE, the regulator's term for it. What is it? What does it do? Okay, it is a risk measurement indicator, so it's a measurement of risk exposure that banks use as part of managing what's called interest rate risk in the banking book. Banking, ordinary course of business, lending money to customers and taking customers' deposits to hold in trust, that generates a kind of interest rate risk. It's the nature of banking business, particularly if the interest rates for either loans or deposits, or both of them, or either of them, is a fixed rate. So the customer product has a fixed rate of interest that stays unchanged from start to finish. So this business generates interest rate risk of various sorts for a bank on the bank's balance sheet. The main one relates to the fact that when rates change, even if the rate on the customer product changes or if it doesn't, when interest rates change, there is some exposure to a lower level of earnings for the bank, and also some exposure to the present value, or the accounting value. Now let's call it present value, the present value of the bank's balance sheet. And this second measure of exposure is handled or managed by banks with this expression, with this measure called EVE. So what is it? That reminds me of a great scene from Red Dwarf when they're going in and out of time. And the cat carries on saying, "So what is it?"
So what is it?
Sorry, quick, back to the topic, right? Sorry, back to the topic. Okay, you can edit that, can't you, Ed? Right, so what is it? Think of products on the bank's balance sheet as having a interest rate repricing tenor. So, or maturity, time to maturity. 1 week, 1 month, 3 months, 1 year, all the way out to 20 years. The interest rate repricing tenor refers to how often the rate on that customer product, whatever the product is, changes. Just imagine you borrowed money from a bank for 5 years at a fixed rate of interest. So the interest rate repricing tenor of that product would be 5 years because the rate doesn't change. On the other hand, let's say you took out a mortgage from the bank and that mortgage rate can be changed at 30 days notice, because it's floating rate or variable rate is the expression we use in the United Kingdom. So if you took out a mortgage which with a contractual maturity of 20 or 25 years and the interest rate you pay on it is variable or floating, and the bank can change that rate at any time if it wishes to, provided it gives you 30 days notice, what would the interest rate repricing tenor of that product be? Well, that would be 1 month, because the rate can change at 30 days notice. So the interest rate repricing tenor determines where in this chart the cash flow, the notional amount of that loan or deposit goes. So we put the notional amount of those loans and deposits in their interest rate repricing bucket. That gives us a net number per tenor bucket, 1 week, 1 month, 3 months, etc. We have a net number, a plus or minus number, going all the way down this term structure. So if there was 100 there and 0 there, that would be minus 100. And if there was 100 here and 0 here, that would be plus 100. By the way, the plus or minus isn't that significant at this point. So we take the net number and then we present value them. We use a standard corporate finance discounting technique, usually described under the expression the time value of money, to take this cash flow number here and determine what its present value is today based on the discount rate for that tenor. Okay, so the 1 week discount rate will be used to take the present value of the number here and put it in there. The present value of money becomes lower the further out in the future you go. So if you were to receive £100 in a month's time, what would be the present value of that today? Well, it'll be pretty close to £100. On the other hand, if you were going to receive £100 in 30 years' time, what's the present value of that today? It's going to be a number a bit lower than £100. So we have the present value for each tenor bucket down here. And then we sum that number, okay? That number here, we sum all those numbers to give us a present value of the whole balance sheet. That's the bank's balance sheet. That's the present value of the whole balance sheet. Now, where does EVE come in? What that expression really means is present value of the balance sheet. The regulator expression is economic value of equity. We're interested in knowing how much this will change if the discount rate used to do the present value changes. So just imagine the rates we were using here changed up or down by 2%, which is in fact one of the standard measures that the regulator requires banks to use, the standard tests. If we change those rates and they went up by 2% along the term structure, this present value number, of course, would change. And we're interested in the difference between today's EVE and what it would be if this was up by 200 basis points. And the difference between those two is usually referred to as the delta EVE, okay? Or indeed we can use that little Greek sign that everyone is fond of in consultant world. So delta EVE measures the change in the present value of the balance sheet for the change in the discounting rate that you are using to calculate it in the first place. Et voila, there we are. That's what EVE is and how we use it in banks. Thanks for watching. If you enjoyed watching that video, do please look out all the other ones we have on this topic and on other topics on the channel, and indeed subscribe to the channel, and hopefully there'll be lots more there for you to get into. Thanks again. Bye-bye.